Axel, welcome to the Income Flip podcast. I appreciate you joining us today from Spain, right? Which is wonderful. Thank you. Thank you so much.
Yeah, thank you for having me.
My pleasure. Well, I love the fact that you're actually doing this podcast from Spain because it shows us that you're creating a life worth living, that you've been creating a life worth living. And as always, on the Income Flip podcast, what I love to do is feature entrepreneurs, business owners like you that are on that income flip journey where you're flipping your active income into passive income. And when people go on this journey, it is an adventure. It's a journey, and I'd love to learn a little bit about your journey, your adventure. And so, Axel, how did you get started in this wonderful world of real estate investing?
Well, the very first kind of little bit of sniffling into the area of real estate investing happened uh, when I was still in the Air Force and we were stationed in New Mexico, running a very large project that also meant to bring a lot of people from Germany to that US Air Force base to co-locate flight training and be able to train and fly together. And in a community of about 25,000 people, it wasn't easy to bring like 800 people, about two-thirds of which had families, in and find housing for them. And one thing that, as the program manager, I wanted to avoid was to kind of build like on base housing, like a German ghetto kind of thing or something. And everybody in the community was okay with that idea. But then how do you build houses and apartments and stuff like that for that large number of people? And so I saw there a first opportunity to maybe take one of those properties as an investment property. It taught important lessons. Let's put it that way.
Well, what are some of those lessons, right? What were some of those lessons you learned on that first one?
Um, well, one of the things is, at the time I had not really any kind of strategic thinking about why this was potentially a good thing, other than the assumption that, okay, we can get into this property, the government is going to pay the rent for the tenants, so you wouldn't really take a risk. And the hope was that the properties would also appreciate, even though as somebody who was only in the area relatively recently, I wasn't really very familiar if that particular area was known to have a lot of appreciation. So that was the one part from a purely kind of like business development and profit generation or appreciation development. The other part was to falsely assume that when people have a job with responsibility, that would warrant to assume that they have a certain basic understanding of how things work. And what I mean by that is we put a squadron commander into the house that we invested in as the tenant. And at some point, they decided it would be nice to make a little fire in the fireplace. And then the fire department was called, and we as the owners were called to find out that they had claimed not to know that you have to open the chute when you actually make a fire in a house, or otherwise you will ruin the living room. So the
Oh
assumption
boy.
that somebody who flies fighter jets and is a squadron commander would know that there's a chute in a fireplace was wrong, and it was an expensive assumption.
Mm, all these little lessons we learn along the way on this journey. Okay, well, it
Yeah.
sounds like that didn't deter you from buying your next one, right? So that was kind of like the first one.
Well, it gave us
Where
pause.
did that
Let's
lead?
put it that way.
Well, where did that lead you? Right? Like obviously, yeah, you were like, we'll probably never want to do that again. But obviously, you changed your mind along the way. What made you change your mind?
Well, part of it is circumstance, and part of it is, I think, gaining knowledge. The circumstance that changed mine was I ultimately retired from the military, got a job in a software company in California. That was all fine, but after a few years and getting another degree in school and stuff, I basically realized I don't really want to continue to be a W 2 employee. I want to have my own business, and I started a consulting company. But that also meant, okay, if I don't want to make or have that job forever, right? Then the question was, is my military pension ever going to be enough to sustain us without having this consulting company or some similar form of income? And the answer was pretty clearly no, which then begged the question,
Hmm.
okay, what else could we do? And I started searching and researching while we basically had found a house and so forth. And if you look at the timeline of when something happens, um, the consulting company basically worked fine. But one of the crazy things was that almost all my clients were on the East Coast and we were living on the West Coast, you know. And at the time, it wasn't like work from home. You had to literally go to the client and be present. So I got like diamond status on United and diamond status on Hilton hotels and all
Hmm.
this, you know, diamond status on Hertz rental cars and what have you. But it basically made it clear it wouldn't really be smart to be that far away from your clients. So my wife and I started looking where could we move a little bit further east without losing the benefits that we really liked. And as I mentioned before, I was stationed in New Mexico and we went skiing and spent driving through Santa Fe a bunch of times while I was still in the military. And when we looked around, we found, hey, Santa Fe is actually a pretty nice place. It's well located. It's only like a little less than an hour away from an international airport in Albuquerque. So we ultimately found a house, but it was at a time where the market was such that had we sold the house that we were living in, it would have been a huge loss. And so then we said, okay, well, the experience with renting wasn't so great last time. And even though we could have and maybe should have blocked up the fireplaces because our house had two fireplaces, we didn't. But actually, but we rented it out and turned it into an investment property and then moved to Santa Fe. And that was much more on the basis of, okay, what can we do consciously now, knowing much more, having done all these programs, you know, and starting with cassette tapes and then DVDs and things like that. What can we do to give this property the opportunity to regain its value? Originally intending to say, well, we maybe rent it for a while and then we sell it.
Hmm.
And even though we
Hmm.
kind of did this, in the meantime, I learned about something that I'm sure you're very familiar with is the 1031 exchange. So when the property had regained a lot of value, way beyond what we ever paid, so there was actually really a good amount of equity in it, we then said, okay, now let's see if this 1031 exchange thing really works and let's find properties that are well performing. And so
Hmm.
that's how the majority of the property portfolio that we have now evolved, because we sold that expensive Santa Barbara property and 1031 exchange in a whole bunch of smaller properties in better performing markets. And ultimately, you know, just like I love to come on your podcast and talk about it, I like to talk about stuff in general. And people heard me talk about this stuff and kept saying, hey, you know, can I do this too? Or can you show me how you did this? Or how did you find this? How can you do this and be so far away, right? Like whether you're in
Hmm.
Santa Fe or in Santa Barbara, you're still far away from Ohio. So, and I told him, well, I researched it and I learned about it, and there's such a thing like a turnkey provider, and that's what I do, and that's why I only really need to talk to them, like, you know, maybe an hour a month, you know.
Got it.
And
So
ultimately, you know,
you
the
what
business was born that way, basically to say, hey, you know, if so many people, or at least some people, want to know about it, maybe I should put something about it out there.
100%. I think, what I hear you saying is, you started becoming more long-term strategic thinking around real estate investing. Like how can we actually take this one asset that's now appreciated in value? You probably when did you buy that house? Just out of curiosity, in Santa Barbara. What year?
2003.
2003. Okay. And then when you decided to sell it, and 1031 it, what year was that?
We sold it in 2011.
We did.
Christmas, we sold it in 2011. Like,
No, we moved in 2011.
no, we moved on Christmas 2011.
I think
But it
we it
was like
was more.
September
I think we
2011.
sold the house in Santa Barbara like 2018 or something like that.
Yeah. Yeah. So you went through that period of where you bought in 2003, it appreciated in value. And then in 2007, 8, 9, it went down in value. And you were like, oh my God,
Right.
like what happened? And then you held on to it.
Yeah.
Right. And so it just kind of goes back to one of those things that, by 2018, it then had come back, in value. And so it's one of those things. So like, buy real estate and wait, right? That there's a clue that's there,
Right. Yeah.
and you
Yeah.
yeah, and
The long
you
term
didn't
perspective is important. Yeah. Exactly.
you didn't have all the answers in the beginning. You're just like, this seems to be a good idea, and so I'm gonna do this, and then through that you learned, and then you did a 1031. It sounds like you bought like 9 properties. Is that correct? Is that what I read?
Eight.
Right,
Eight. Yeah. We have
eight
more now, but
properties.
we had
Pro-
eight at the time. Yeah.
Wonderful. So you used 1031 to essentially buy properties all over the country, or did you pick Ohio specifically?
Well, we had joined a couple of organizations, and one of the things, and keep preaching the same fundamental mantra was, don't put all your eggs in the same basket. And so we thought, okay, well,
Yeah.
how much can we do? And we had originally identified more than 10 properties in two markets, basically. The market, I call that still the west of Chicago market, which is right at the border between Idaho and Illinois. And then the second market was Ohio. We're now in the process of adding basically a third place or third location in Florida, but that's, we did kind of 50-50 in those two markets.
So, what was your approach to research those markets? How did you decide to go into those markets?
Well, in my research in general, even before we ever considered to have something like a rental property, I don't mean the first one, but like after moving to California, I learned about things like, for example, the 1% rule as one of the very early performance measures to say, okay, if I go on, nowadays we would say, if I go on Redfin or Realtor.com or Zillow or anything like that, and I look for properties for sale, how do I even have an idea that a property that's there might be worth searching more deeply? That was before I ever heard about the concept of turnkey providers. So this 1% rule served really well and still does today, because it tells you very quickly, okay, if there's a property, let's say for $150,000 and the expected rent is $1,000, you don't need to go any further than that, because to meet the 1% rule, or at least be close, it would have to be somewhere between $1,400 and $1,600 in rent. Reasonable. Not just
Mm-hmm.
because
Mm-hmm.
somebody said at the outer edge of possibility, then it might get 1,500. No, it should be comparative to everybody else. Nowadays, we have great tools like Rentometer. You can just put in the address and say, okay, what are the rents of similar properties in the 1 mile radius? And that gives you confidence that if Zillow or any of these platforms makes a claim about potential rent, it is either reasonably or it's totally out there.
Fantastic. So yeah, so you went off of that 1% rule, and as values have increased all over the country, it's been more and more difficult to find places that have the 1% rule, but they're still out there. I'm sure you're researching, different markets. So did you look at anything else besides the 1% rule? Did you look at job growth? Did you look at like what were some of the other things that you looked at?
Well, it was the first thing to say, okay, let's narrow it down to properties that we can say, okay, they meet that rule. And you're right, it was much easier at the time than it is today. Then we went to say, okay, what kind of neighborhoods are there? What kind of employment is there? What kind of migration do we have? What kind of crime? Even though I had to learn that the crime statistics information is sometimes not really that helpful and far away sometimes from reality. But like in our Illinois Idaho cluster, the biggest local employer is John Deere. Are they going to close shop and not have their world headquarter anymore in the location? Doubtful, especially because they're selling like hotcake in the reasonable vicinity out there, right? Like that's I mean, they're selling worldwide, but they're like an anchor um, employer, just like you would want to have an anchor tenant in a huge mall or something like that. And So that was one thing. And then with the Ohio cluster, it had to do a little bit with the fact that I was told when I retired from the military that to have any chance to do anything in corporate America without already coming with lots of experience. And yes, I had 20 plus years in the military, but it wasn't the same like working in a company. So they said, well, what can help you and balance this out is if you get a graduate degree. And I got it from Antioch University, where the headquarters is in Ohio. So I went to Columbus and to Dayton and to Cincinnati, which is kind of the three big cities in the area around the university. And I had a little bit of an idea how the area looks like. And we ended up investing pretty much right next to one of the biggest Air Force installations in Ohio,
Mm.
which is kind of like the Air Force material and supply support center for pretty much everything the Air Force does worldwide. Not that they have it all there, but they're organizing it all there. So those are the kinds of things where you can say they're probably not going to leave anytime soon. They also have the Air Force Museum
Hmm.
there. So, it's kind of, like the Rock and Roll Hall of Fame is not going to move, and the NFL Hall of Fame is not going to move, and stuff like that, right? And so the Air
Hmm.
Force Museum is probably not going to move. The Wright brothers are not far away. So, that kind of stuff. So those things actually played a role. It's the economic environment, the likelihood of finding tenants that can afford the properties, those kind of things.
Yeah, I love that. I love the idea that you were looking for anchor companies, anchor businesses, anchor uh, culturally, like something that was just anchoring, right, your cluster of properties. So so when I was reading on the website, and deep diving a little bit on your background, it, when you did that 1031 tax exchange, there was lots of hurdles that you had to face. Like you completed the 1031 with maybe just 4 days to spare, and it was probably stressful. And you probably realized that there was a lot of things broken, in that process, in that system. What were some of your ahas? What were some of your lessons learned for anybody else that's listening, thinking about doing a 1031 tax exchange? You need to go from one property into eight, right? What are some of the pieces of advice you'd give somebody?
Well, for one, I would say if you are trying to do it yourself and you have never done it before, I thought it would be advisable to learn about it, like, Google it, so to speak, plus work with a 1031 exchange organization, because that's anyway required to sequester your funds out of the sale. Like you sell one property and you don't get the money, the money gets sequestered until you have basically the other properties and you're executing the purchase of the other properties. But I did the research and I did hook up with a really good company. I like to say the one thing that I didn't have was somebody other than that company that had, from an investor perspective, actually gone through it. And the company, even though they did a great job and we actually finished everything, and I want to maybe say some little word, if you allow me to, for about those 4 days. But
Sure thing.
if I were to look at my situation as it was when we went through it, and if I look at it, if one of my clients right now were to go through it, is what I learned in this context is it's really, really helpful if somebody gives you the full picture before you even get started. You say, okay, so here's your current property. Here are all the things you want to consider about that. Here's the first step is what happens to the money. Here's the second step, what happens in the first 45 days. Here's the next important thing is what happens after you identify, and why should you identify more properties than you ultimately need. What is happening within the overall 180 days that you have, and how do you actually go about it, and what eventually. So really tell the whole story, kind of like as if you take somebody through it like a movie, right? Like imagine, you have to slay the 1031 dragon, and here are
I
all
love
the
that.
things that you have to do, right? And then you can go home and tell the story to the village or whatever, so that's basically what I was missing. To me, it felt like I got the pieces, but they were given to me as if somebody was thinking, well, the guy can't handle more than this little piece that is relevant right now, and only in hindsight, and that's what I meant when I said I want to speak about those 4 days, I had always thought wrongfully, just because nobody told me, and it's not really that well described, that the conclusion of a 1031 exchange means you went through all the steps all the way to the end. Sorry about that. So what I learned afterwards is you can theoretically also have a partial exchange, right? Now the idea is to say, okay, I have a chunk of money, whatever the profit is that I made through my sale, I want to apply that completely 100% so I don't have to pay any taxes on any of it. But in our case, what I also have on the website about the last 4 days was literally for the last property to close. So what would have happened if it had closed after the 180 days? Well, we would have had 7 that fall into the window, and the little amount that was in that 8th one would have not counted for tax-free, and we would have had to pay capital sales tax on that amount of the down payment of that purchase. So that was part of, like when you tell the story, to say, okay, and, nobody says that you have to wait until the dragon is dead. You can already leave when it's pretty clear that you have done your job, right? And stuff like that. And I didn't know this, and it creates a lot of anxiety to push and rush. And I probably annoyed the Tax 31 people to no end with all my phone calls and questions and emails and text messages, because I thought the whole thing would fail if not all would have closed on the or before the last day. Right.
Yeah, that's great advice. You really need a guide. You need a Sherpa to be able to almost like start with the end in mind, right? Like kind of take you through the whole journey. I love that. It's like take you through the whole hero's journey of what it's going to look like, right?
Yeah, exactly.
And is
Well, and
that
if
what
you
you?
know a little
Yeah,
bit,
Axel.
you can start anticipating as well, right? That's a big benefit to say, okay, I remember I was told this is something I should expect.
Axel, is that what you do today? Is that primarily you're still obviously you're in a point in your life where you're looking to retire somewhere other than somewhere in the United States. So that's pretty cool, right? But it sounds like you're also taking your consulting experience and now applying it in the world of real estate investing for others that are also going on this journey. So do you want to tell me a little bit about what you do there and how you help people through that process?
Right. Yeah, absolutely. I mean, the mentoring program and the mentoring in general that I'm offering is for the purpose partially of, if somebody were in a position to say, I want to do a 1031 exchange, to help him through it, doing exactly like I was just describing. One of the other components that I found to be really important, and I only learned about it relatively shortly before this 1031 exchange had happened, was that if you actually intend to invest in a location where the properties perform really well, like we were speaking about the 1% rule, then that can be quite a ways away from where you live, right? So this whole notion that I have investments and I can somehow oversee them, or I somehow have to take a call from a tenant or stuff, obviously doesn't work when it's anything more than an hour's worth of drive away. So if anybody looks at the map, you don't even need to find Santa Barbara. If you just look at California and you look at Ohio, there's no way it wouldn't even make sense to get on a plane, right? Regardless of the cost.
Mm-hmm.
So what I discovered as one of the solutions to this whole approach was to invest with turnkey providers. Right. And that is an
Mm-hmm.
important component, because now when somebody says, okay, I would like to work with you as my mentor, it's not just learning that and a bunch of other things about protection and entity structures and all these things that we do, but also to say, okay, I have groomed relationships for myself and now beyond that for our clients with turnkey providers who, as I always say, find the ugly duckling in a good neighborhood in one of those areas. They renovate it, they put it on the market at a price that it appraises for, because otherwise you wouldn't get lending, and they also get the tenants and manage the whole stuff for you, right? And so that
Mm-hmm.
was a discovery in this in this process that I went through, and I believe that's probably one of the most important and unique things that we offer at IdealWealthGrower is we're not just teaching you, we're not just saying, hey, here is an interesting property that we heard about, but we basically give you this whole package that you need, including insurance and lending and the property itself and all of the things that are needed. And in my experience, most of the time, after somebody has gone through that 2 or 3 times with my help, then they can pretty much go and keep doing their hero's journeys on their own.
On their own. Yeah, that's I love that. And and Axel, as somebody sets off, because I can see you really appealing to people that have maybe not started their career entrepreneurially, right? Maybe they worked for a corporation, maybe they worked for the federal government for an extended period of time, and then there's some psychological leaps that have to happen when somebody decides that they're now going to go on this journey, right? As a wealth builder or real estate investor. How do you typically guide people through that process? How did you yourself go through that process, right? Because I think that's part of the journey, right? Like you went through the fire yourself, you slayed the dragon, and then you're in a unique position to be able to help people go through that probably have very similar backgrounds. Like for me, I was never W-2 employed, right? Like I would pretty much the age of 24, I started my first business, and it was much easier to take the leap when you don't have anything in the beginning, right? You don't know any better, you're dumb, right? And you don't have anything. But I could see that there's patterns that people get stuck in over a 20, 30-year, 40-year career, and now venturing into, something that's more entrepreneurial like that. That's it's a big leap psychologically.
Yeah,
How
absolutely.
how
I
do you
mean,
guide
so
people through that?
I had 22 years Air Force, so that's kind of like military service. I had almost 5 years in an executive role in a company. But I have to also admit, like you just did, that I actually had learned quite a bit as the owner of my consulting business before I ever gotten into creating IdealWealthGrower as a second business. Fundamentally, what I'm doing in our mentoring program is to help people realize and start developing the behaviors as the king or queen of their own empire. And I really use this
Hmm.
terminology in this way because in overdoing maybe the words a little bit is important to get through. And what I mean by that is if you really look at it and you say, I want to build a company that holds all my investments and I'm the owner and leader of this company, then from a mindset perspective, it's important. And that's part of what I'm teaching and mentoring about is that anyone that is needed to make that successful is in a sense similar to an employee. Just forget for a moment that they don't really have an employee contract and they don't get a salary in the traditional sense. But the turnkey provider is managing your property. If you work for anybody, regardless, there is somebody who does facility management, right? Then you have lenders. If you have most 99% of companies in the world today, they have some sort of line of credit and stuff like that, right? So the banks or the lenders work for you. The property managers that are ultimately after the purchase, the ones who manage your properties are your facility managers. You have insurance. Any company has insurance. So you work with an insurance provider, an agent who provides insurance for you. You have a lawyer who protects you both on your privacy, your anonymity, and on your behalf if any tenant or anybody is saying, hey, Rob did something wrong or Axel did something wrong and I want to sue them. You have a legal structure that makes it harder for people to get to your assets, but you also separate your legal structure from your personal stuff so that you never get into a risky situation where somebody says, in this particular house, Rob, the owner, is doing something wrong or has bought something that is illegal, and now we sue him and win, and we get an award for a couple of $1 million. In the structure that I recommend for our clients, where they are like in this what's called a series LLC structure, the maximum risk they have is that one house and that one LLC within their structure that they can lose. Worst case. And then we put the whole thing ideally into Nevada, where rarely ever anybody gets even to a court hearing. right? Because it's very hard to say, okay, somebody who owns something and has it managed by somebody else, it's just, then the company is responsible when an employee made a mistake. Now, there is some responsibility, but even if you assume that, then the worst case out of, like in my case, our portfolio, we could lose one. In the worst case scenario. Imagine, like most other people, you own everything in your name, you signed on any mortgage in your name, everything is in your name. Anybody gets an award, they can take everything. Everything you all worked for all your life
Mm-hmm.
could be gone. Right. And then ultimately, when somebody is taking the full program, the full 1 year program with, biweekly sessions, then we also get into estate planning, family trust, and those kind of things to really build the structure necessary for generational wealth. But those are the things that are above and beyond just thinking about investing and really thinking about how can I transition from somebody who is dependent on an employer or the government to pay me every month to being in charge, and also recognizing when I'm in charge, then the bank works for me, the insurance company works for me, the property manager works for me. And like in any other company, if they don't do a good job, you get somebody else.
Mm-hmm. Mm-hmm.
But we are
Mm-hmm.
conditioned, especially when you have a lifelong career as an employee, you're conditioned to basically be a beggar. So what I say, and I wrote a mindset manual about it that I give to everybody, even to your audience, and you and anybody can get that for free, to say, how do you get from the victim mindset to the creator mindset, so that you create your own
Mm-hmm.
future and you take responsibility for what you want, and then build the team around it, hire, so to speak, the team around it that you need to accomplish your goals.
Yeah, I love that. It is. We teach this methodology called the 7 levels of wealth, and the first level is all about thinking and energy and identity, and it really is a mindset piece, the foundational
Yeah,
piece that
exactly. Yeah.
launches everything else like on top of it. Because if you don't have that mindset piece right, if you don't have that energy piece right, everything else becomes very difficult, or it'll crumble. It's like building a house on a foundation that's not strong and solid. So I love that. Um, so my question for you, Axel, is then what's next for you as on your journey? Right here, you are. You retired from the federal government. You're looking for a different location around the world to live in, which I think is unbelievably awesome, right? Because I think a lot of people wish that they would do something like this, and they dream about doing something like this, but they never take the action to do it. So maybe there's some words of encouragement that you give people, or some lessons you're learning through this process, and also, where would you like to take this business that you've now launched to help people on this journey?
Well, the good thing is I have developed all the relationships that are needed for anybody that comes into our community, or we call it our tribe, to benefit from, right? Like to lawyers and accountants and turnkey providers and banks and insurance and all the things that you need. One of the things that I really enjoy is constantly educating and keep learning for myself in on behalf of the clients, to see what other options, or if I stay with the picture from before, what other employees can I find that might in certain circumstances be even better for what we want to accomplish. One example is I have a relationship now with somebody who used to work for a hedge fund and then started her own company. The company's core business is DSCR loans, which is not that different from a bank mortgage. It has some differences, and we don't need to go too deep. But they also, because of that background to the hedge funds, have access to private lenders who are willing to build or create what's called bridge loans. And what that basically
Mm-hmm.
means, if you take a practical example, is you can say, okay, I take, let's say, a $200,000 property, and normally you have to either 20 or 25% down payment. So that means $40,000 to $50,000 down payment. But you can get a bridge loan and reduce that down payment to something like 15,000 or maybe 20,000. And yes, you have a hit or a reduction in your cash flow. But when you look at the proper performance, you would calculate that all in and come to the conclusion, okay, instead of, let's say, $300 or $350 positive cash flow after everything, I only have 100. But the bridge loan is for 5 years and it's very situational. Big picture. I go always back. This is something that is really one of the big lessons learned, is look at the big picture and ask yourself, will the Fed be able to retain the current interest rate level for much more than 2 or 3 or maybe at the outside 4 years? And I don't mean like this actual level right now at 5.5%, but like even if they start gradually reducing at the end of this year or early next year, until we get to something where we can say we can get an investment loan with a 5 point something again. How long is that going to take? I would right now venture to say somewhere between 3 to 5 years from now. So if I get a
Mm-hmm.
5 year
Mm-hmm.
bridge loan where I have the right to pay it back any time, what does that really mean? Do we really pay it back? No, we would actually say, let's say in 4 years we have, instead of 8.5%, we have 5.5%. We would refi. We would also most likely have a little bit at least of additional appreciation in the property. So we pay off the bridge loan, we get a new mortgage at a much better rate, which does two things. Number one, at a much better rate, we keep more of the cash flow. And number two, our cash on cash return is astronomical because we only paid 15,000 to begin with. Right.
Yeah.
So
You
that's a
use other
creative
people's
thing
money.
so that's something that I did honestly not have on my radar 2 or 3 years ago. And that's just one
Yeah.
example. And there's other things, like I've always preached that what do you do with your positive cash flow? You have basically two options. On the one hand, you can say, I do extra principal payment to shorten my mortgage term. But most people who want to build a portfolio want to use the money in an accumulation account of some type so they can sooner rather than later do the next investment, the next investment, and the next investment. Especially if you don't start with a 1031 exchange like I did, but you really start, okay, here are my first 25,000 and now I need to see that I get the next 25,000 for the second property. So one thing that I did as a guinea pig just when they started was to get into what's called fractional real estate investing, where you have tokenized real estate and each token is $50. Well, if you think about it, if your properties make $150, $200, $250 a month positive cash flow, and I don't know anybody in our investing tribe that really needs the money to survive, then you can buy 5 tokens every month. And those
Mm-hmm.
tokens are basically allowing you to participate in the same kind of performance like other residential real estate, just on a much, much smaller level. And when those tokens have accumulated close to what you need for your next investment, you just sell them all and you buy your next investment and rinse and repeat. Right. So that is something, tokenized real estate and all that plays around with it. I didn't know. I had to kind of keep my eyes and ears open, learn about it, do it myself, which is the promise I give everybody who works with us. I am always willing to be the guinea pig and try it first. And if I find it works, we do it. And if I find it doesn't work, I warn you about it. I wanted to buy an eco-friendly tiny house in Panama. Thought that was a great idea. Couldn't figure it out, not because it doesn't exist, even though they still haven't, 4 years later, still even started building. But couldn't make neither the financing nor the whole legal structure, couldn't make it work. I don't know how many
Hmm.
people I saved from trying it, but I tried it and it didn't work. you know.
Well, it's interesting, Axel. I looked at, I remember when I started seeing the tokenization of real estate happen, and I was like, ooh, I think this is the future of how uh, real estate will potentially transact. But when there was a period 2 or 3 years ago where like everything around NFTs, everything around tokens, it was like pretty hot, and then it got cold because of what happened, right? Um, but I still believe that the tokenization of real estate is going to be um, a big deal, and you're very very early in that process. Like I talked to a lot of people that said, well, it's going to take a long time for it to become mainstream because of the way title is held. There's no central place for title. Like it's all it's all county by county by county, and it's going to be really hard to make that like a blanket tokenization of all of real estate. And like there, and by the way, there was only a couple companies at the time, 2 or 3 years ago, that were even attempting tokenization of real estate, right? So
Yeah.
I'm curious, who did you end up using for that?
Yeah, I ended up working with Lofty because I, through a lucky circumstance, got to know one of the founders before I even actually joined. I interviewed him ultimately on my podcast and let him explain how it works. And there were a certain number of attributes, and I'm not saying they're the best or the only ones by any means, but they have a number of things that I believe are unique. Like, for example, this issue about title. For any property that is being purchased, they immediately create something called a DAO LLC that owns the title and then tokenizes basically the title into $50 a piece tokens. So that, and there are a couple of other rules, but that is, for example, one of the mechanisms that helps to solve this issue that somebody says, okay, the company owns a portfolio and anybody can kind of purchase tokens in a sense like an average, right? Like, so you literally own the
Mm-hmm.
tokens of that particular property, and that particular property is held in a particular LLC that is only in one LLC for that property, which is very close to what I do with the series LLC structure for my
Sure.
own portfolio. Right, so that is an important similarity. The other thing that appealed to me at the time and still does today is that they set up their system so that what's called the ledger, meaning like your income and outcome, income and expenses for rent income and any expenses on the property is balanced every day, every 24 hours, which also means for us, when
Wow,
we look at it
that's
for
pretty
what
cool.
do I do with my positive cash flow, I can put it in. Like, I can buy a token. If I have like $150 cash flow, I can say, I like this property, ABC Main Street, and I buy 3 tokens. And by the time I have some opportunity where I want to make an investment, at the end of that day that you make that decision, you just sell the tokens and you have your cash and you can immediately send it to title and make it as a down payment or as an earnest payment or whatever it may be, because your ledger is always balanced at the end of every day. The other cool thing is, because of that, if you don't have the need, I have, for example, my whole reserve for all our properties sitting in that. Anytime, more than $50 in rent has accumulated, I buy another, even just one token in another property, because you get this waterfall effect, where I can't even tell anymore in some cases if a token is the token of a token of a token of a token over the years. So
Well,
and then you
would
get,
you say would you say that a token is just another word for a share, like a share
you
in the
could say that
property?
if you only look at the LLC, and the LLC has like equal pieces of shares or tokens, legally and tax wise and so forth, it's different. But for easy understanding, it is kind of similar. As far at the first moment when you say, okay, this $200,000 property has 4,000 tokens of $50 each, you could also call them shares. After that,
Mm-hmm.
things change a little bit, especially the stuff with the ledger and how rent is applied and for your K1 and all this kind of stuff. But fundamentally, for easy understanding, is you can theoretically own up to 15% of a house in the form of these tokens or shares.
Interesting. I'm definitely gonna have to deep dive on that,
Yeah, what's
Axel. Very
also
cool.
kind of cool is,
Yes.
I mean, if you think about it, because you are a co-owner in that LLC, whenever there is any intention to do something, like, for example, should we spend money on a renovation or should we put it on the market? The community of owners is voting on that, right? And there are certain rules. If you, for example, if one owner, which if you and I are both having tokens in the same LLC, and you say, hey, I really think this thing is not performing as well as I thought, you, as even with one token, can say, hey, platform or coordinator, I request for the owners to come to a vote and decide if this thing should be sold. And then we all vote,
Hmm.
and for a sale, it needs to be a 2/3 majority. And if the rest of the token holders all say, yeah, Rob is right, then we give it to a realtor and put it on. And the good thing is that at least most of the properties have no mortgage or anything on it, so they're free and clear. And but that's those kind of things. If you look at what kind of rights do you have as an owner, it's pretty amazing conceptually. And for any of your really youngest people in your audience, you can even purchase the tokens with crypto.
Yeah, no, I love it. I love it. I definitely see. I think you're early on this. I see. I see this as a way for. Well, I see this as a way where a lot of things are going to move eventually. Like I know within my organization, like we, buy Airbnbs, and I allow members of my team to buy into that one entity, that one LLC,
Right.
and own a stake in that entity, right? And we all have to vote on any repairs, and we have to essentially have to be in consensus with that. But we didn't do it through tokens, right? We did it through ownership shares. But the tokenization of it is actually pretty cool. And I guess the difference would be we have actually a traditional loan on that particular property. So maybe that's the only way that you could do it. With tokens, you would almost, like you said, they would have to be owned free and clear. So potentially um, that would be a way, like you get people from your tribe to all buy this one particular property, and all of your money now owns that property free and clear, and your percentage of your tokens, the amount of tokens you get, is equivalent to the percentage of money that you put into the purchase of that.
Yeah, that's true.
I
But
would
I mean, you
imagine.
also have to, yeah, you have to keep in mind. I mentioned that the whole thing is organized on a platform where the platform owners are basically, in a sense, the conductors of an orchestra. And as long as we're only
Hmm.
looking at one property, everything you said is obviously true. But when you say, okay, now let's say we have a platform that has 100 properties, and all the people have at
Yeah.
some point to different levels understood how tokenization works, then you have more than just a purchase and sale option. You can also say, okay, how about I want to get more tokens in this property and get rid of some tokens in another property. And what happens is there will be there is a marketplace, at least on the platform I am at, where you can say, okay, well, I might like to help somebody who is in a bind, and the tokens are for sale for less than the $50, and I
At a
can actually
discount. Yeah.
increase. There's actually a crazy guy. I shouldn't say crazy guy, and a very ambitious guy who said, "Okay, I buy any token for $10." I like I said, I'm pretty well connected with the founders, the two founders of the company, and one of them, the CEO, told me the other day, there is this guy who basically every day he puts out a message on Discord, um, that he is willing to buy tokens for $10. And when he first started this, I was sitting there and I said, Jerry, if you would have told me that, I would have thought the same thing. There's no chance in hell that anybody is selling him tokens for $10. Guess what? There are sometimes situations where people are so desperate that they actually sell them tokens for $10. And I mean, you can't even calculate the return for the
Yeah.
tokens. That
Yeah. Of course.
it's pretty insane. But that's actually one important lesson that I also have to say, because I was very early on this tokenization. And I don't know if this applies to your Airbnb situation, maybe not as much. When you look at the properties, I learned that there is much more of the human condition, quote unquote, greed aspect that starts flowing in, because when the operators first started, they asked the community, what are the kinds of properties that you most look for, so we can kind of try to find them. And the one measure that people were massively interested in, now you have to think about, this was like 2020, right before crazy interest rates and
Hmm.
stuff. Everybody said, we want maximum cash on cash return. Well, so they went out and they found properties with like 13, 14, 16% cash on cash return. And guess what? They ended up being in locations where the dependability of tenants wasn't great, where the quality of renovations wasn't great, and stuff like that, right? And I feel super, super lucky, because even those, and I'm using a French term here, these shitty properties, right, ended up appreciating at least enough so that you don't lose money when you actually sell the tokens. But nowadays, now after a bunch of years, it's one thing to ask, and people might still say, I want maximum cash on cash return. But the operators have realized that the amount of churn and questioning and disappointment and all this kind of stuff going on when you have an initial calculation and then the performance isn't showing up because of insane repairs or tenants not paying and evictions and what have you, that they are now much more consciously vetting the properties that are even coming into the community and into the platform. And yes, they're not as amazing on the numbers as the very early first few properties. But I can tell you as a long-term investor that most of the early properties are either currently for sale or have already been sold, because the community
Yeah, it's
ultimately
interesting.
realized if we are too greedy, then we have all these issues. And even though as a token holder, you're not really dealing with the issues, but somebody has.
It's interesting. I learned that lesson entering into a sub market years ago, where on paper everything looked phenomenal, right? I could buy a duplex for $50,000, each side rented for $500, right? That is well beyond the 1% rule. You know, I'm making $1,000 on a $50,000 asset, right? The 1% rule would tell you that would be a $100,000 acquisition. But because they were in a subpar market where the area was dying and not growing, and because the tenant pool turnover was super high, um, what looked to be great little cash cows on paper did not end up being great cash cows on paper, and truthfully, those properties never appreciated, like really didn't appreciate. And so what I learned from that is something that Charlie Munger said to Warren Buffett years ago when they started thinking about their philosophy of investing. Because Warren initially would look for really cheap deals, like really like home run kind of deals. Like it didn't matter what kind of asset it was. And then Charlie Munger said, no, no, what we're going to do is we're going to look for good assets, like really good assets at a fair price. Good assets at a fair price, right? And that became, and so as real estate investors, as we start thinking about that, we want to look for good assets, great assets at a fair price, as opposed to sometimes we can be seduced by these things on paper look like they're little cash cows, but they're not good assets. They're bad assets because they're in areas that just have high tenant turnover, right? And tenant turnover is the number one killer of cash flow.
Yeah,
Bottom
absolutely. I
line,
mean, you have to
right?
also think about, when the founders started the platform, they tried to offer some, like would probably say, and I would say more stable properties. And so you had one that said 16.5% cash on cash return, 1,500 tokens. The other one said 9.8%, 900 tokens. And guess which one was sold like within 3 minutes, and the other one was sitting there and nobody bought anything. They were just waiting for the next 16% property, right? And there's a little bit, I mean, that's just human nature. If you identify a property and you basically sign a contract with the expectation that within a reasonable, I mean, they didn't expect to sell within 3 minutes, but let's say within a month or 45 days or something, keep in mind it's a cash payment, right? A cash purchase. And then the tokens are sitting there. Um, I'm not 100% sure, but I believe, even though they never admitted it, that some of the early properties were actually bought by the founders because nobody bought the tokens. So
Yeah,
um,
yeah,
they
yeah.
made a commitment and they wanted to keep it. And then they put the tokens on the marketplace, because it made suddenly sense when you compared the 16%er that ended up being a 2%er and the 9.8%er kept its 9.8%, then it suddenly became a great deal, So that's,
hmm
those
hmm
are the behavioral things that I want to say, are important, not just for tokenized real estate or buying anything on these platforms, but we always, I believe, need to keep both components, the purely mathematical stuff, or the logical stuff, if you want to consider that. But then there's also the behavioral stuff, which goes to, like we said earlier, to mindset and where do you see yourself? How do you see yourself? How do you position yourself in the environment? How much do you
Mhm.
know of all the different variables that influence the environment? And sometimes, and I'm not saying that I was always free of that, you see something and your brain just says, I got to have it, and only later do you find out that, it's the same thing like not opening the chute in the fireplace.
Well, Axel, if my audience wants to find you online, what's the best place they can go?
Yeah, if you go to idealwealthgrower.com, in the top right hand corner, you find a little button that says discovery call. I'm always happy to have a complimentary discovery call, see what you need, what you do, what you have, and how I can help you. And we go from there.
Wonderful. Well, thank you so much for pouring into the discussion today. I love that we ended up on tokenizing real estate because that is a very cool concept and something that people should deep dive and do some research on themselves, learn a little bit about that because I do believe we're going to see more and more of that in the future. With that,
Yeah, I agree.
make it a great day. Yeah, make it a great day. And thank you so much for joining us.
Yeah, absolutely, Rob. Thank you for having me again.